Hey, this episode is brought to you by the outstanding team at Compass Strategic Advisors, your trusted partner in driving strategic growth. Whether it's expanding into new territories, launching products, rebranding, or hiring key staff and board members, they offer expert guidance every step of the way. With a versatile approach and a proven track record, Compass is the go-to resource for both startups and established companies looking to scale with confidence. Show some support for this podcast by sharing this appreciation and checking out their website at www.compass-strategic-advisors.com. Well, this is exciting. I get to welcome Neil Jesani to the Liftoff. Neil is based in Miami, Florida, and I haven't had a friend on from Miami in a while. Neil, welcome to the Liftoff.
Great to be with you, Kit. Thank you.
Folks, you may not be aware, but Neil is one that super founders go to when they need to scale their business from, say, 20 million to 100 million without losing a ton of money in preventable tax mistakes. So they can build real generational wealth and exit on their terms. So Neil and I are going to chit chat a little bit here about not just building a great company, which is so common in my on my program, but how to save a lot of money as well. Do you mind having a little bit of that discussion, Neil?
Absolutely. I love that.
Yeah, so talking about slashing tax bills, that is always of interest to super founders. What do you find is one of the key ways for them to do that?
Whenever we are talking about tax savings for the founder, you can do at the multiple levels. So one is at that other exit time, right? So that other whenever, let's say, eventually every founder's goal is one day to exit, either in a form of taking company to the public or to sell it, or that other some form of exit we are looking, right? So that is what is one. Second place you do the tax planning is ongoing basis. So what happens so many time at the early stage founder don't have a tax problem because they do have more kind of actual cash flow problem because they will be keep investing in the growing the firm, so they will not be. But once the company is stabilized and once you are have the real customer and when you're making money and when you're also taking the distribution out, then on the yearly basis they will be having the tax issues basically, because if you are making actually a couple $1 million, obviously, if you are in California, you're paying half of that money in the taxes, basically. So you can do something at the yearly basis, and we do multiple strategies, starting from depreciation-based strategy to that the actual charitable donation-based that actual strategy, or that are the something we can utilize that are the call actual business loss limit, that are the also based strategies. So that actually so many strategies you can do on ongoing basis. And especially if you're getting, let's say, most of this founder, they must be getting W-2 because their company would be structured as more kind of
Sure.
actual Delaware C corp, basically, right? So that actually they are getting is primarily W-2. So we can do magic at the W-2 level as well, and that other probably cut the tax bill in half on the ongoing basis. But there will be a lot more fun at the exit time, basically. IRS Section 12 or 2, small business tax, basically, and that other under the OBB, the new bill, it has even got better. So that actually you can do quite a bit stuff with that one. So that actually you can shield 15 million one person, but then you can create multiple irrevocable trusts. You donate your shares, and you can shield substantial money from the taxes. So there's actually quite a bit strategy can be
Yeah.
done ongoing basis as well as at the exit time.
So it's interesting. Maybe we break it down between while you're still a private company, but you're planning on growing or you're seeing that growth and you see a potential exit coming. What do you do when you're private before you become public? And then what are the strategies to take once you filed to go public and now you have shares that you could sell? What are some of the things you should think about?
Sure. So that other what happened? There are you can put the entrepreneur probably in a two bucket, right? One is more kind of, I call them accidental entrepreneur, basically. That guy had no idea. That guy was doing the side gig, created LLC, and start selling something on Amazon or, so something like that one. And that it actually took off. And now that guy's, doing the 100 million, and, he has 10, 15 million EBITDA margin, basically, right? So that is one area. So in that scenario, that guy, you probably need to do the right kind of entity planning, basically. So he might be LLC, tax as S corporation. So I mean that once that guy is going to start making some money, he's going to start looking some IG video or so TikTok video or the YouTube short, and people say, hey, if you have LLCs and if you have some money, then you should do S corp election. So they will do the S corp election because it's going to save some money in that other, that are actually self-employment taxes, basically, especially Medicare taxes, basically. But if that business turns out to be a serious business, now the S corp would not cut. Basically, you need to do the proper planning with your entity, basically. So that's where we convert it from the S corp to that actually C corp, and we like the actually Delaware domicile and so on and so forth. So that is the one bucket of the entrepreneur. The second one is the entrepreneur from the beginning, meaning people are incubating the project. They are actually raising the fund. So hopefully they would have got the right advice from the beginning, either from the angel investor or they knew a little bit. So those people will start as more kind of actually Delaware C corp, basically. And the reason you do that one is that the C corp will give you a lot more advantages down the road. Obviously, it's going to, even though it is kind of actually double taxation, but if you were to take money out when you are actually founding the growth firm, you are not looking to take money out. You're looking to take money out in the form of exit, basically, right? So in that scenario, C corp would be great. And that we like the Delaware because Delaware is much more easier to create the option pool for the employee. It is also great for taking the new investors, basically. You can have the foreign investor in your company and so on and so forth, basically. So these are the two bucket. Now that once they have the right kind of entity structuring, now we are talking what they can do. So let's say when you are looking to exit or there's something like that one I said that you can use something called 1202, IRS section 1202, or we do certain time is before you plan to raise money or sell it or exit, we would like to do the valuation of the company. So you can do valuation at the lower current valuation, basically. And then that actually what you do is that whenever you're selling, so before that one, we create some offshore company, we can create that actually domestic base as well, that other. So essentially, I'm talking about private placement, and you sell some of the stake in this newer company, and then once you go to public or when your time at the exit or that you are selling it, you can exercise the option at the time. So it is a very, very powerful way of shielding not only income tax but the state tax as well, because most of this founder, they don't realize that initially they are worried about the state income tax. That hey, I'm making $2 million, they can see half the money goes in the taxes, I need to do something. But at the same time, they are also building a net worth, basically, so that now you're ended up paying the state tax if there's something were to happen to you, or the eventually when you're passing your asset to the next generation. So you need to plan for the state tax as well, basically. So that actually this kind of strategy will help you not only with income tax, but will also help you with estate tax planning as well.
Interesting. And I have to consider capital gains as well as I looking at that. How do you view capital gains and what advice do you have on that topic? And I know there's some legislation that's always being kicked around.
So that essentially all of these people normally is going to have the capital gain, unless I have seen so many instances where actually founder has sold it and they think so it's going to be capital gain, but the buying company would give them as that actually ordinary income. So now suddenly you are paying almost double the taxes, basically. So, but that generally, if you structure your deal right, basically, then it is going to be capital gain. But even with capital gain, If you are in a state of, say, that in actual California, then you are paying the that in actual capital gain, 20%, then you pay net investment income tax on top of that one, and 13% California state. So that actually you are paying something in the range of actually 35% plus you are paying in the that actual capital gain, long-term capital gains. So all of the strategy would work for the actual capital gain as well. On top of that one, you can do some that actually charitable based strategy as well. Those can be very, very powerful. That other way to do that one. You can do some of the actual depreciation based strategy as well, basically. So yes, you can do it either for ordinary income or for the actual long-term capital gain as well. Either one is fine.
How do you assess it when a company is really early stage, Neil, as we deal with so many startups, right? So you're a Series A company, you've raised $10 million and you've been granted an equity stake in the company. You're an executive, maybe you even have 1% equity in the company. Do I buy that stock right away, or do I wait a little bit and see how the business is going before I pay for it? There's some tax implications with buying it in advance or waiting. What do you recommend?
Ideally you shouldn't be finding nobody buying at the time, because even though you're stage A, business is very, very difficult game, right? You understand, you talk to entrepreneur day in day out, and the that actual business is that unless you are at series C and pre-IPO level, different story basically. But early stage there's a lots of still risk to the business basically. So that normally that you don't buy at that level basically. But that I would probably exercise that once you are at C level, or that other pre that actually IPO level, then at that time you can do that one basically, but not at the that other series L level.
And what about the case where there's a market evolving now where I can take my private shares in my privately held company and sell them to a third party marketplace who is then marketing
Secondary, yep.
that stock and selling it to other investors? Is that something you advise on, or is that how do you evaluate that kind of a decision? Obviously, if you need
Sure.
money, then you try to get a little bit of liquidity, yeah?
Actually, secondaries are actually getting very, very powerful, and
Mhm.
it is actually a great way. But again, that would be at the Series C plus or pre-IPO level. Absolutely. At the time, I personally believe that again, it depends on the actual personality of that person as well, and how risk averse that one. But I would probably take some chips off the table. I would probably do some secondary, because the business is also IPO cycle, this business also dependent on the external environment as well, right? So many a time, it's not you have done anything wrong. If that external environment changes dramatically, then that the IPO is not happening. Okay.
Yeah, so we were talking, I mean, a lot of times these startup companies, um, before they get to C plus, as you point out, that's 5 years. That could be 10 years. So these companies are looking to get a little bit more liquidity to buy a house, to go on a vacation, to put a kid through college or something. So what are the tax implications then of moving my money to one of to getting rid of some of my shares through secondary?
Sure. So that other I personally believe you don't have a lot more opportunity, because at that time the investor do not like either you are, say, senior executive or you are founder, you liquidate some of your shares at the time basically. So that is kind of a bad sign. That's what I look at. But that's been said, let's say if the investor allows you to take some chips off the table, or that actually liquidate basically, then it is essentially that it's going to be your ordinary income basically, what time the exercise you have exercised. And from that point onward, let's say that whenever you are actually granted, it is going to be your ordinary that actual income. Now from that point onward, if you that other get the growth on that one, that would be considered, if you hold it for more than 1 year, then it would be considered long-term capital gain. Otherwise you are essentially paying the ordinary income.
Interesting. And Neil, do you do some advice with clients, entrepreneurs, as in terms of setting up family trust, putting some money into kids' accounts and other family structures? And how does that help with some tax savings?
Sure. So that other By the way, we have a two full-time estate planning, very, very senior level that actually estate planning attorney on the staff, and we do quite a bit advanced work. So that essentially, when we are talking about the trust kit, essentially trust falls in two category. Okay, revocable and irrevocable. By the way, none of this the tax strategy helps with income tax. Okay, normally it is being done either for the convenience or for the state tax purpose, basically. And on top of that one, I think one area that we need to touch upon is the asset protection. What happens is once you start making money and once your net worth grows and once you're in a limelight, people are going to come after you. They want to sue you. They want to take your money. So once you are at this stage, you want to start really building multiple firewalls, right, around your asset and your future income, basically. So that's where the asset protection would come into play. So that's where this trust will make a lot more sense. So that actually family revocable trust we do, that is primarily for convenience purpose. It does not give you any income tax or state tax advantages, basically, but it creates lots of convenience, meaning, God forbid, something were to happen to you, there will not be a probate. Your the spouse or your beneficiary gets that money, and is there's no probate, there's no public records. I think
Can
you
I
were
can I translate that into entrepreneur speak? So you're helping
please.
me build, you're building me into a company to protect me against me as a family person. You're putting me as a company person, and then putting a shield around that or some kind of umbrella, almost like an insurance policy. It's a tax policy.
Absolutely. That is what essentially what we do. That's where we use the irrevocable trust, basically. So whenever you use the irrevocable trust, technically you are donating your ownership or your share to the trust, okay, which is does not own by you. It is created by you, but it's not owned by you, basically. So meaning it that other protects in case of loss or if there's something were to go wrong, not only that are the, let's say, some third party, but even something were to go within that helps you to that actually protect whatever you have created up to that stage, basically. So irrevocable trust, and we use primarily domestic asset protection trust. Unless your net worth is more than 100 million and you have some fear, we would look for the offshore trust, but otherwise we try to stay within the that actually us.
That's interesting. So now talk to me about some of the real hidden tricks, but also, troubles that you've seen founders, entrepreneurs get into when they've had a lot of money, but they haven't taken the right steps. What are some of the common mistakes that are made?
Sure. So that other you will find the mistake from the tax angle as well as from the investment angle, basically, right? So I'm just gonna actually break it down in a both, basically. So that actually so many time founder they are successful because they are obsessed of building the company, right? They have no interest. They have no interest in finance. They have no interest in tax. They have no interest in accounting. Only thing gets founders' attention is two things, right? It has been said that it is either new revenue or somebody say, hey, that if you don't do this one, then you're toast. You're done. Companies, that other done. So those are only two things gets the attention. They have no interest in normal stuff. So I have seen lots of issues in terms of the actual tech side. So either they don't plan properly, do the poor deal structuring, basically. So that's where you will find. So those are the one areas one need to be very, very careful. The second area basically is on the investment side. So now they have a money, and until now, their business or their company is their investment, right? But now that other you have that actually 50 million, you have 100 million, you have a 200 million, you got it, and that other what to do. So I think that's where you will find the lots of mistakes happen in terms of investment side. So I think that is where first thing they need to do is the global asset allocation, basically. So let's say you have a 200 million that actually you got that one, you divide that one and say that how do I put it? And then you do the strategic investment. Now that other also one need to be careful is that other sometimes mistakes happen is people try to follow somebody else, but I think you need to understand who you are first. As long as you understand and what is your goal and what you're going to achieve in a life, I think the investment decisions becomes easier. And that I'll give you the example. Let's say that you like to grow your money really fast and you want to go next level. You got the 200 million, that's great, but hey, I want to be billionaire, right? So then that other, if you will get the traditional investment advice, meaning, that will actually diversify. No, diversification kills the return, right? Basically. So that the idea is that if you're looking for the high growth, then obviously you want to have more kind of, actually concentrated position versus somebody say, hey, that I never imagined that I'm going to have this much money. I'm very happy. I'm comfortable. I'm not looking risk. Then obviously that other, actually diversified portfolio is very, very important.
So this is you playing a key role as an investment advisor. Do you like to recommend formal investment people on the team, as it were, to make the investments and set up the asset allocation models and risk models? Is that something you do, or are you part of that effort?
Sure. So no, that actually we do. So I do own the another company called Neil Jesani Wealth Management. So that actually we are boutique, actually wealth management firm. We start the relationship with 5 million and above. So that minimum relationship we take is the 5 million.
Right.
But that's where we do the real asset allocation, and that we are that very very heavy on alternative asset class, such as actually private equity, actually private credit, that other VC hedge fund,
Yeah.
that other actual structured product, actually those kind of things on top of the normal traditional, stock market basically. But that we are that very, and that there's so many times people don't realize that private market is way bigger than the public market. What we know is the Amazon and Tesla and Google and Nvidia and
Yeah.
those kind of things. But people don't realize there's a much bigger market which is a private.
Do you have an example, Neil, of some of the things you like recently that you've tried to put some money into on behalf of your clients?
I do understand investment well, and I do sit on an investment committee, but I don't make investment decision. I'm more on a tech side. That's my passion. So
Yeah.
I do have a different team. We
No, I
have
get that's smart.
CFS and CFPs, and those are on staff, and they do. But I particularly don't give an individual investment advice, even though I understand. But my passion is really on a tech side. But I do understand the global asset allocation.
Yeah. Are you seeing some things happening? I mean, we talk about OBB, we talk about different tax legislation, things that are happening now that might be in the current environment that entrepreneurs need to be aware of as well.
That actually you can put the entrepreneur in that other multiple bucket, but I'm just going to focus on the high growth companies and people are making lots of money. So that other, obviously one is that the actual bonus depreciation has you actually got back with the 100%. So now meaning you would be able to depreciate the 100% of the asset right away. So let's say you buy some big piece of equipment, basically. Let's say you bought, that actually $1 million worth of equipment. Guess what? You would be able to depreciate right away 100%, and you can take it right now. So that is back, which is going to be very, very important for the entrepreneur.
Yeah.
Second one is the IRS Section 1202, basically. That was 10 million, went from 10 million to 15 million, become very, very important for the founders, basically. So they need to follow. Also, they allow that even you can have liquidity even before 5 years. Otherwise, used to be that 5 years, but now you can have that actually the exit before 5 years, and still you can have 60%, 80% of your that other that other gain would be excluded, basically. So that other IRS Section 1202 is very very found that actually very very powerful too. So these are the two mainly impact the our audience. Those are high growth company, high net worth founders, high income founders, basically.
Interesting, interesting. And you also, I would imagine, help them with their business account, but also their personal account. How does a founder normally balance the two with you? Do they
Sure.
normally take their personal over to Schwab, Quicken, or do they bring it all to you, a business that tries to handle both?
Sure. So mostly, even though we do have a team and we have yeah, actually PhD level people in the staff, those are PhDs in the tax and accounting, and we understand that things very, very well. But most of the time, I have seen that we are not great for early stage founder where there's not lots of profit. We create lots of value when you are really on high growth, you have a really high EBITDA margin, your actually top line is, actually 50 million plus. That's where we can create lots of value. But that on the individual, as long as you're making more than couple $1 million, we can create lots of value. So most of the founder comes to us for their individual situation. They will bring their, actually co-founder or something like that one, and we do the individual based strategy because the on that actual business side, you want to be very, very careful because goal of the business is to eventually get the exit, right? So you don't want to push any personal expenses to that are actual businesses, and that other one should not be doing either way. But that other, even though you're allowed to do that one, you don't want to do that one. And that number two, also in that all of this kind of company, there's investor, so there's going to be quite a bit, actually scrutiny would come into play as well, basically. So that generally we said, why don't you have your business accounting or that actually finance is done by some of the actually mid-market accounting firm or that other whatever your investors suggest, because many a time the investor will have their own terms and say, hey, that I want my accounting firm to do your accounting, basically. So that is fine, and that
Yeah.
we handle the individual side on that other actually founders, basically.
I think I understand that pretty well. Isn't it kind of funny, Neil, how accounting has this perception of being such a boring business, but here we sit all the time talking about companies going public and how exciting this phase of the market is right now, where companies are finding liquidity now through these big acquisitions and big IPOs. It's all about not how much you sell for, but how much you keep, right?
Exactly. So I think that what happened, focus changes, and that, as you said, that the early stage, when there's a no profit, I don't know it is going to become anything or not. So I don't care for taxes. I don't care for the accounting, right? But once you are somewhere, that I learned earlier on, if that somebody say, hey, look, I don't care for the taxes, meaning that guy is not making money. If that guy is making serious money, he would be
Yeah.
very much worried about the taxes, because when you are cutting the check to IRS or, actually, California state or, any other state, millions of dollars, it hurts, that even though you are making money, but it hurts basically, right? So you want to look for all ethical and legal ways to, that actually minimize your tax burden.
I think that's so important for founders to realize. I've had the good fortune of taking companies public and having some exits. Um, but it's funny that the actual price the company sells for, either in an IPO or in an M&A, doesn't always reflect how much I'm taking out of the business. Because
Exactly.
there's so many different, steps where you get diluted and liquidity, and the founder really needs to understand that.
And that they need to really engage earlier on and engage the real good advisor. I have handful of story, Kit, that they come and they said, "Oh, I sold the company. Yes, I need to pay capital gain tax." And when we look at, it's not capital gain. They gave them the actually ordinary income, basically. So that other actually quite a bit surprise happen, and those kind of things that other, even though you feel good that other you made 50 million, but now you are paying taxes as the ordinary income versus long term capital gain. So that it does hurt. So in that scenario, get the real advice. That all this founder understand that end of the day, right people is everything. So once you get somewhere in your life, it's the skill, it's the knowledge. That's what is most valued.
Yeah, and so we want to wrap up a little bit, Neil, but we've so helpful. But share with me a tip or two that we haven't been able to touch on yet that will really help the founder and that high net worth individual hold on to more of their money and protect themselves.
Absolutely. So that the actually first thing I would say is they do have somehow the notion, or we've been brainwashed that when you earn W-2 income, you cannot, do any tax planning. Basically, that is what is general notion, and that it's true that if you're making $500,000, there's not a lot more things you can do. I mean, that other, actually you can do, but it's not a lot more valuable, basically, right? So that the idea is that once you get at the serious level, meaning when I say serious, meaning once you're making more than million or so as the W-2, there's a lot more strategy can be implemented, basically. So that is number one. Number two, that other, that other make sure that your books is done right, because end of the day, that other you are going to get the multiples of your EBITDA, right? Basically. So you need to make sure that other, because so many times people don't realize, but whenever you're trying to sell the company, or there's going to be, once you sign the LOI, the investors say, hey, let me get the access to your book, basically, right? And that I have seen, Kit, this is actually very very important topic we are actually talking. I have seen certain time companies, they had unfortunately not so smart accountant, and there's going to be phantom income tax issues, basically. So there's, they have used that actual cost basis, and they do have negative cost basis, and those people haven't made money, but now they have to pay taxes on $10 million income. So, but I don't have $10 million, but that is you have used on the that actual pass, basically. So that the actual second thing I would say is make sure your book is done right, basically. And the third and final one is, even though you are at the early stage, needs to have a right estate planning document,
Mm.
and the asset protection in a place, because the asset protection is a real deal. Once you have a money, it is actually a matter of time. Basically, somebody's going to come after. That is what nature of the beast, right? It's like, that once you have money, you are going to become, it's like, that other once, you become some famous, you need some security around you. That's what it is. It is not right or wrong, but, that's what it is. So that similarly, once you're going to start building some, that actual net worth, you need to make sure that you start building those, actually firewalls, basically.
Neil, this has been fantastic. You've given us such great tips. I feel like I just saved a bunch of money in my tax bill. But you got to sharpen, you got to keep that pencil sharp. And
Actually, thank you for having me, and it was absolutely fun. Yeah,
my
we will do
pleasure.
it again.
We will do it again. And good luck. I know we're not at April 15 right now, but I know we have a tax bill due coming soon.
Absolutely.
Best of luck, Neil.